Budget and Finance Committee meeting will come to order. We have two sets of minutes, the April 26, 2010 regular committee meeting minutes and the May 17, 2010.
Move approval. Second.
Any comments? All in favor say aye.
Aye.
Opposed, no. And then number 3 is the updated financial model.
This is probably the meat of our meeting tonight, or discussion tonight, is an update on the financial model. We've talked about this a couple different times over the last few months as we look at what we planned for and included in our funding model and funding plan that the board approved, and what has really happened in terms of project costs, financing costs, and the group of projects that we actually are implementing. As we know, we did choose to remove one of those projects in that funding plan as well. So we took some time working with PFM to update that model, and Russ has assembled some other information to sort of show where there are changes in terms of cost factors within that model. And we wanted to bring PFM to show you that tonight and walk you through that and answer any questions you might have and help facilitate a discussion around that. So, without further ado, we'll ask PFM, Lauren and Ryan, to come forward and talk with us today.
Long time no see.
And Ryan's passing out the presentation, which I understand you got last week. It is in a bound format, and it also includes one other report.
Slightly updated.
There's one noted changes on slide 7. There was the Moody's medians, which we use to benchmark ourselves against. It still referenced the 2008 medians. We found that is now referencing the 2009 medians. That's just on slide 7. So we have corrected that, and that's what's included in the handout that Ryan just passed out. Also, I'd like to take an opportunity. This is Ryan Childs with PFM. He also works in our Memphis office, so thought I would bring him along, not only to be another set of eyes on the road, but also just so he can meet everyone. So we're glad to be here. So I'm going to walk through this, and feel free, as always. Y'all know the drill. Y'all can ask me questions that interrupt. I'm free however y'all want to handle it. So I wanted to walk through kind of right off the bat and let you know where we started updating in terms of a lot's changed since we last spoke in terms of revenues, expenditures, as well as your debt. First things first, we went in and we updated your fiscal year 2010 numbers in terms of revenues and expenditures and where you look like you're going to end the year. Now that we're getting close to, well, we've actually passed the fiscal year end. When we did this, we worked with staff to kind of come up with good numbers, really scrub them, where do we think we're going to end up. We also went in and said, now that you have adopted your fiscal year end for 2011 budget, let's go ahead and put that in there. So this includes revenues and expenditures included in your fiscal year 2011 budget. Since we last spoke, we also have worked on a few bond issues with Russ and his staff. $44 million where it was issued at the end of calendar year 09 in December. This included 2 series of bonds, but we'll refer to them as we talk through this as just the Series 2009 A and B bonds. There was a portion of that you'll receive a 35% subsidy from the federal government. So in terms of debt service cost throughout our model, we've backed out that 35% of interest that you will receive as a subsidy payment. So this is net interest cost to the city. Just recently, we'll actually close this bond issue tomorrow. The city issued $15,725,000 in recovery zone bonds, which was a state allocation, inclusive of an allocation from Williamson County and then an increased allocation from the state. This one is similar to the Series 2009 A and B bonds. It also includes a subsidy payment, but of an increased amount of 45% of the interest is paid from the federal government. So in terms of debt service for the Series 2010 bonds, we have netted out the 45% that you will receive in terms of on your debt service cost.
Oh, okay.
Also, as I mentioned just briefly earlier, is Moody's released their 2009 medians. They released them in April of this year. They benchmarked, produce the medians for AAAs, AAs, and single A credits, and that's what we've tracked ourselves against. Those were the 2009 medians. When we went through this process the first go-around, we used the 2008 medians. So we've now come in and updated those for benchmarking ourselves against them. Any questions about the kind of overview of what we actually updated? Growth rate assumptions has stayed as is. They're very conservative. We did not change them. In fact, all growth rates are off of the fiscal 2011 budget.
I've got a question, if I could. Whenever you were preparing to sell the bonds, this most recent issue, was this data available to the people that were buying the bonds?
It was, not in this format, but
Right.
when Moody's and S&P come in and they individually rate the city per bond issue, they go through the same process in terms of, they look at every aspect of the city, and they produce their own ratios, and they prepare a report that is available to the investment banking industry, and then they also then send it out to investors. With that being said, S&P and Moody's both produce a report. Some have more meat than others. Some of them are more just general kind of like discussion about the city, and then you'll see like Moody's is much more specific in terms of where the city stands in terms of revenues that came in for fiscal year 2009 and what's expected in 2010, as well as they go ahead and touch on the 2011 budget. So this is available for the investor in the event they want to look at it. Okay, so we went through each individual ratio that we did in the past to kind of track to see where we're at. First one is the general fund balance as a percent of operating revenues. Moody's reported this in particular. They said it was strong and that it was in excess of 50%, and then went further to say that they accounted for it at 56%. I believe they were using a 2009 number, but nonetheless, we're right on top of that. It's a very aggressive percentage in excess of the 33% policy level. This also includes the AAA, which is kind of hard to see because it's actually right on top of the city's policy level. The city policy level is the orange line. The blue line is AAA medians for 2009. Something I want to point out here is that in 2008, the median was 37%. In terms of the AAAs had a general fund balance of 37% of operating revenues. In 2009, the median went down to 32%, almost right at 33%. So you'll see it's right on top of the city's policy level. The AA and single A categories, there was a slight move, but not as substantial. The AAA categories where we've seen kind of the most fluctuation in these ratios, and I can't say I can explain why, but I have to think that they have a little bit more of flexibility in terms of what they can afford, what they can do with their money, and they have other aspects that will really carry them in terms of their credit strength. That is still an outstanding number and nothing to be concerned about at 32%. So what we see is this, it right now shows a slight decrease in 2011 and a continual increase. This can be accounted for by a gradual increase in the revenues projected versus the expenditures projected. This includes all expenditures inclusive of the debt service that you will have to pay within 2 new bond issues, net of the subsidy you'll receive. It does not include any use of fund balance for capital projects, and I understand that that is likely to be something that we'll want to look at in the future in terms of actually, you know, if it's a minimal amount, if it's either for capital projects or for operations in the future, maybe in fiscal year 2012.
Because we were saying that the ones from last year, I think, did show that we were presuming we'd be using the $5 million draw, and this one does not at this time. And it may not be necessary, but it's still, it looks better because it doesn't have the $5 million drawdown, which would affect all these percentages.
Right. Any other questions?
When you go back to, when you mentioned 56% of the fund balance, What were you referring to there?
Moody's, actually, when they rated you this last time for the 2010 bond issue, they actually referenced that one of the strong credit factors was your fund balance and how strong it is, that the 33% is your policy level, but what you actually have is in well excess of that, and they actually referenced 56%. I don't recall if
Currently,
I would,
at the time?
actually, that number is probably,
We
Right.
projected around 50% in our budget. They may have done their own calculation and arrived at 56, but what we show in our budget document, and the budget you approved with, which includes our estimates for spending in the recently completed fiscal year, had us around 50%. Now, those are probably fairly conservative numbers. Our spending may not be
Yeah, which is fine.
as high as is assumed there, but that was their calculation.
And then actually may be of, as a fiscal year 2009 or 10. I don't remember how they referenced it, but they definitely pointed it out for your investors to see that this is something they want them to be aware of, that this is, first of all, you have a policy, your policy's 33%, and that you are maintaining well in excess of that, and they calculated at 56%.
because really, if you base it on anything except our new budget, which is lower than the
Sure.
previous budget, it doesn't make much sense to say 56%.
Yeah, I was
It's
confused.
49 or 50 from our
That's
calculation.
Yeah,
right.
okay.
I think,
All right.
I
I was just
agree.
They
confused
got
when
to
you
where
said
they
that.
were somehow.
Sure.
And I
And
was
like I
trying to
said-
think that through. That's fine.
It might have been
Question
a-
I got
of
it.
math, you know.
Yeah.
We'll question it
And
after
if
the
it's higher,
bonds
we're
close.
totally okay.
Yeah, we're okay. I don't
But
care
like I
about
said, it
that.
could have been a fiscal
We're
year
conservative.
2009 or 10.
Yeah.
I don't.
But see, our budget then was higher than it is,
So they
It
could-
is.
so it would make it harder to get there.
You're,
If I may, I do think there are some things in there that they exclude when they're
Sometimes they
doing the
net out.
math.
Oh, okay.
Remember, we have a big operating transfer to solid waste and to transit. You know, when they look at budgets, I think a lot of the times they look at the pure operations of our ongoing services, and that's what they consider that.
Okay.
So they make adjustments to all of
And
them.
maybe the transfer to the pension fund as well, too.
They may have netted out that
They could have.
to go true operating costs.
That's a good point.
and Russ is
Yeah.
probably right on target there. They are, that has been somewhat of a challenge, is how they reference ratios and things that versus how you see an issuer or city go in and reference them. And it's been a real question in terms of how you account for your fund balance, and now with GASB coming along to kind of regulate how you account for fund balance, we expect there not to be as much of a challenge in the future, that we'll all be speaking the same language when we talk about fund balance, so.
All right, thanks.
Uh-huh.
And when we do it fairly simply. We
Well, we're
We're pretty conservative.
Yeah.
What's the
That's
budget?
good.
What's the number? We do a very simple
On the
calculation.
conservative
We
side,
don't
yeah,
net things
which is
out when we
absolutely-
give you that number.
Okay.
On slide 4, we have the debt service as a percent of operating expenditures. This also includes the two recent bond issues, the net of the interest subsidy that we will be receiving, so what's truly the obligation of the city. We've updated the Moody's medians. Those were relatively small changes, probably nothing material for me to point out for you to kind of see a distinct move from 2008 medians to 2009. What you see is that we are in excess of the policy level, and that was projected moving forward and actually taking on this additional debt. One thing to be aware of in terms of the debt, in terms of how it affects this ratio, we've issued $59 million in debt since we last spoke, the $15 million and the $44 million. Not all of it is absolutely supported by the general fund. There's other sources of revenue that will pay that debt service. So what we took into consideration when we do this calculation is how much debt is supported by the general fund and really needs to be accounted for in the general fund. So we actually take a percentage of the debt and allocate it to this ratio. Moody's and S&P will look at the debt service in entirety. However, this will allow us to kind of step back and give them some frame of reference for other revenues that are pledged to that are available to pay the debt service. So right now, we'll see, and you can see when in 2011 where you start seeing that additional debt come on board and continue, and obviously over time you continue to pay down the debt. That your debt does not increase over time. We've structured all the debt that we've issued in the last 6 months as level debt service, so there's no increases in debt service or spikes in your debt service. In fact, over time, as you continue to pay it down, your total debt will decrease.
but we need to say two things here. One of them is this does not assume the cost for the total cost for Hillsborough Road for Third Avenue extension. And I don't know about McEwen. I don't think we said that.
Third Avenue Extension is included in the 15 million
It
that we
is
just
included.
issued.
The whole 7
That whole
million?
cost is in there in terms of the roadway project. Now, all of Hillsborough is not, because only a portion of that project is in the recovery zone. Up to Del Rio is in the recovery zone, beyond that is not, so we could only use those dollars for that purpose. So we do have a portion of Hillsborough still to go, but all of Columbia, all of Third Avenue North Extension are incorporated in that 15.7 that was just issued.
Now, the Third Avenue I'm talking about the Third Avenue extension, not Hillsborough or Fifth Avenue, if you want to call it, from 96 up to Del Rio. Is the Third Avenue extension also part of the recovery?
Third Avenue North Extension?
Yeah.
Yes, it is. We made sure that that map reflected that project as well, so those three projects would get captured in the recovery zone eligible projects.
Hillsborough, second.
I think one of your questions is there $7 million in there for that?
Right.
And the answer to that, I think, is probably no.
Okay.
But, I think there's some discrepancy about what exactly is in that project, and I think we're supposed to have an update on Thursday night to break that out. But this is for the road portion of that.
And we were talking about that
About
some of that,
3.7 million. Yeah.
3.7
Yes.
I
million
believe that's the number.
of the Third Avenue. And is Mr. Parker's here, is the rest of that going to be from stormwater or whatever? Or do you want to?
Part of the project is still, until we decide what we're going to do, we're going to be bidding it as alternates as part of the park. So that, I think, is hotel motel. I'm not sure. Then you have some stormwater also.
But in general, 3.7 is going to be close to the road portion of it.
That's my understanding.
To the best
We
of-
don't have the final thing, and we will not have it Thursday, by the way.
Right.
Even though we thought we would, we're still working with that.
Okay, it's in recovery, okay.
But I think to the best of our knowledge at this point, we feel as if we have the road portion covered to the extent possible.
And that's a similar number that was included in your funding plan. It was broken out the same way.
And remember, part of it is grant funds.
And we've got the trail
Oh, yeah,
grants.
the trail
Right,
fund. Yeah.
Okay,
Right.
but
Well,
the rest of Hillsborough is not in here,
Right.
is that
Right.
right?
Yeah, we've got
Del
about,
Rio,
just
what?
around $9 million of
right.
Hillsborough is in here. I'm using round numbers and then
How
the
much,
balance.
9
$9 million?
in there?
Just under 9, I think,
That's right,
8.8 or something like that.
8.8.
Okay, so we've still got the
Then you've got,
presumed other, whatever the rest of Hillsborough is not,
Oh, yeah.
is not in this, and not in these calculations, because for one thing, we don't know what that will be.
That's right.
But the other thing is that, now what about, is all of McEwen in here?
No, phase 3.
No, I meant that little piece that we decided on. We're...
Phase 3?
Phase 3, yeah, thank you. Phase 3, is that
That's in here.
already,
you've got a portion of that, the balance of that is to come in the future. That's the,
How much of that do we have in here? Because we had 4 million from the state, and then we have
it's about a $12
about
million.
7 million out of our pocket, right?
Yeah, we've got about 1.8 in here.
Our share's about 8.
If you look at the memo that Russ and I provided you, on the second page, in the middle, it's got sort of a bond use summary that will talk about what's been allocated within the 2 bond issues that we've done to those projects.
So we've actually used almost $1.8 million of the bond proceeds to pay for part of that. And if you'll notice at the very bottom, there's about 5.3 million of the 44 million that is left and not assigned yet. It's not assigned because we tend to want to pay the first bill in the door, regardless of which project it's from, because we have a limited amount of time to spend the money. So we always tend to apply it to the first project that is completed, as the bills come in month by month.
It'll be Columbia.
Okay, so, but if the McEwen is 12 million total,
4 million from the state. Roughly 2 million spent so far, and another 5.3 million that is available for that. So we're in the vicinity of having that funded.
that would take almost all the unassigned,
Oh,
right?
That's correct.
You will have a third issue. It may be a year or two out. What we've done is we've pushed the borrowing to the front end because we had such favorable terms with what the market was doing, as well as these Buy America bonds, both the regular and now the super Buy America bonds, to get an extremely low cost of money, around 3% or even a little bit below in the most recent one. So if you look at it, we did borrow a little more upfront than we might have originally planned to, but it was because of the opportunities that we had to get a very favorable interest rate.
Okay. But I guess maybe I should say then, well, that if we use the unassigned part to the bonds that have already been sold, then we won't have any additional for McEwen. We would have additional for the rest of Hillsborough Road. That's going to have to be borrowed.
That will need to be borrowed. Mm-hmm.
So it will go on top of this right here, and that means that there would be no other projects except the 500,000 small projects. This is not projecting any other projects except those
The ones
projects.
we've already committed to.
And the 500,000 every year. And please notice on this scenario, down is better.
That's right.
We were exceeding our policy.
That's
We were
right.
exceeding our policy.
Until about 2018.
Considering, well, of course, once we get the, whatever it is to do Hillsborough, that'll pop that back up, too.
Right.
What did you use to calculate increase in operating revenues over the year?
There's we looked at each individual line item in terms of your revenues that are available. The revenues then are assigned a growth rate assumption. Everything is projected off of your fiscal 2011 budget, and we worked with staff actually last year to do this in terms of, it was actually off of the original. We were actually, I think, on 09 numbers when we worked on it, so we were being very conservative considering that we were right in the middle of a recession. We have since seen those revenues continue to decrease over the years, over the last 2 fiscal years, so this is actually off of your lowest revenue, your lowest budgeted revenues since we've gone through this process.
So there wasn't a percentage per year that you calculated?
By item, there
You
are
just-
some percentages.
Everything was adjusted, for example, for inflation, and the estimates of inflation were between 1.5% and 2%. But some revenues grow faster than other things. You know, salaries have tended to grow faster than light bills, although not recently. You know, it just depends on the category, and what we looked at were trend lines as far as how things had grown. They were rounded, and they were used, you know, they were averaged, if you will. So, for example, on revenues, we actually had differentiation between years. But on most of the expense side, we typically said this is either growing at 2% or 2.5% or 3% or 5%, whatever it is, and carried that out through a 10-year span.
Do you remember that, I don't remember the specific numbers, but on sales tax, for example, relatively low growth in these initial years, and
Then
then
picks up.
closer to historical, not too historical, because we know that those are some pretty significant numbers. We're not that high, but we did sort of ramp that up over a multi-year period to get that up a little higher, but still in the low, like 1.5%, 2% is what I'm remembering, but I don't know if you remember that off the top of your head. But
And I think with
sales
that-
tax was pretty slow and then ramped up to maybe around the 3 to 4 range a few years out.
And I think what Lauren is saying is, when we did those numbers, we assumed, in essence, that we were going to take that first $5 million hit to our operating budget. We've since taken another $4 million hit to that
Right.
budget, and we've applied those same numbers to the lower number, where last year we were forecasting it going from the $54 million level and growing. It's now down in the $49 and $50 million level, but growing at the same rate that we anticipated earlier. So, I mean, there is a chance, if there's a little bit more robust recovery than anyone imagines now, because we're so low, we could be on the low side in the early years. But I think over time, they're pretty realistic. And they're substantially lower than the historic trend lines that we've seen over the last 20 years. I mean, we made major modifications for...
In the last 10.
We made modifications for reality.
Yes, yes.
The new reality.
The new reality, that's right.
And also, you know, we were growing so fast, say, before 10 years ago, that was probably unsustainable anyway, and it was kind of leveling, can we say, somewhat leveling off? Not the way it's done, not the way it's actually done, but even before then, it was leveling off.
One thing I would add to this particular slide is that, you know, when we started in the fall of last year, I don't think anyone anticipating borrowing so much so fast.
Right.
You know, we decided that we wanted to commit to the projects to a great extent because we felt like there was an opportunity, because of construction costs, to go ahead and start the process on these projects. But we would borrow the money over 1 to 3 to 5 years. We've done it all in essentially 10 months. And the reason is because of that allocation from the county and the state. So we've brought debt service forward, albeit at a much lower rate, but we've brought it earlier in the years, and that's why you see the jump in 11 through 14. Where if we had had our choices in a perfect world, we would have borrowed last December, we would have waited a year and a half, borrowed some more, and phased in the money. It would have helped us on the project and the spend-out schedules as well.
But also, as you said, you know, it helps us, the costs are lower, and interest rates, we've got an excellent interest rate. So it's really, I think, to our benefit. So, you know, we're okay there. Even though we're going above that line, I think we're playing it smart.
Well, it's definitely far, far in excess of the city of Franklin's history, by far. I mean, this, you know, we used to have, what, $20 million in debt, and now we've got how much total?
We've got some things to show for it. And I think the demands of our community are such that we have to step forward with some of these roads and services that we're providing.
Well, I'd like to think roads. I hate to say, what road capacity have we increased except what out there's Carruthers? I mean, you know, North Carruthers. The rest of it has not increased the capacity of the roads. You can say.
Well, that downtown area, though, we're never going to increase that capacity because, as we said before, you know, we're not going to widen those certain areas. But I think we've made it more safe, for one thing. I think we've addressed some safety issues, addressed some infrastructure issues that are really, really critical, and that helps our community in Rowan. But I think the key things about those as well is what we just pointed out, the interest rate, the borrowing power at the interest rate level that we have, and the idea right now that we are able to do these projects for a much lower rate than we ever would have 5 years ago. So I think I agree with Kim when he says we do have some things to show for that as well.
And actually, we've reimbursed the city for money that is already spent, but it wasn't bonded. It was just out of the fund balance, kind of, for a temporary, in a temporary situation. So that part we definitely needed to do. But I do think that, though, this does tell us that we have exceeded even the policy that we put together, and by
sometimes you have to do that
by a fair amount. And also the other thing is, I want everybody to understand, This is not including any other projects. This is
We got
not
that
even
in.
paying for everything that we
think
already
that-
committed to.
I'd kind of like to know what Moody's said about this slide, or their evaluation of this, because
To be honest, they didn't, there was no question and remarks related to this being an uncertainty of, can you afford it, in terms of looking at your other expenditures. There was no concerns for you getting into an area where it's not affordable anymore. In fact, they referenced the fact that you actually have a lot of flexibility and resources at your fingertips, considering where your property tax rate is.
I was going to say,
I mean-
bother them because our property tax rate's real low. That's at present.
So they're very comfortable with the fact that in the event that you need to fund debt service, that you have the ability to do so. That you're not going to see folks running for the hills that they can't afford it. So, I mean, that's the thing. That's where they are coming from in terms of them being comfortable with the amount of debt that you've taken on in the last few months. That is also, like I've always said, they don't focus on one thing when they rate the city. They rate you on every aspect that you can think of. The economy's not supposed to weigh in, but we all know that they don't ignore it. They can't. Management's part of it, reserves is part of it, demand in terms of the population, the folks that want to live here, the kind of projects that you're building, the things that you're doing in terms of making improvements.
Yeah, and obviously, they've seen the kind of caliber of the companies that have been moving here and
Sure.
and are still looking at Franklin.
Sure.
So I'm sure that played into it in a big part.
Absolutely. I mean, it's nice to actually go with them with some positive economic development news. One thing that, and I think that we talked about this when we first talked about this ratio, and I want to remind you, is that we actually, this ratio it becomes out of whack even more as you go into another, we're looking at the fiscal year 2011 budget where you saw another substantial decrease in expenditures, but an increase in debt service. So you're seeing not only as a push that this ratio is going to go out of whack because you have increased debt, you're also seeing it in terms of the denominator has now decreased as well.
But it's basically about the same percent. In fact, it's a lower percent, as I look at it, compared to the debt service as a percent of operating expenditures in scenario 7. This is really lower.
It is.
Than what was projected because of the advantageous.
Some of the other factors.
Just some of the other
cost
factors.
et cetera.
The interest rate that we were able to borrow at. So that has been a very good part of it.
Right. We initially assumed that you would borrow around $30 to $40 million at a 3.5%, and everything else would be at 4%, and that you would do that over time. And we've kind of now just kind of moved it all to the forefront and borrowed it, in some cases, less than 3.
That's right.
One of the things I would just point out, the board was very wise when you did this policy, that you looked at a whole variety of measures to get the whole picture. And you looked at the things that the rating agencies look at. And it's human nature to kind of look at where we're weakest, and this is probably the measure that we're weakest on and have the most concern on.
Absolutely.
And as good stewards, you're doing that, but I also urge you to step back and look at collectively these 5 or 6 measures and where we are to get the whole picture. And I think that's what the agencies, bond rating agencies, did when they looked at this as well, and that's reflected in, affirming the AAA ratings as well as how strong the market reacted. The participation that we had in people that wanted to buy this debt and to participate in this is an indicator, too, that they saw this as a very strong credit, that our fundamentals are in order, and these measures, I think, reflect that as well.
Oh, I do need to ask a question, though. In 2011, are we paying back principal on these new bonds?
Which series?
I guess both of them, the 44 million and the 15 point.
The 44 million, yes, on the most recent issue, no. It's interest only in the first year.
And I will tell you that particular program, Recovery Zone Economic Development Bonds, the most benefit is on the long end of the yield curve, because you'll get 45% of that interest
Right.
back. They can't, there's no cap at where you borrow your money, so you borrow it at 5%, you're going to get the 45% subsidy back. So the long end of the yield curve is where the rates are the highest, in terms of you're going to get the 45% subsidy back on those interest rates. That program will go away at the end of this calendar year. So in terms of, like, when you look at Hillsborough Road, where we need to fund the remainder of the project, in the event we did it through debt, you would do it where, on the shorter end of the yield curve, where the rates are cheaper for you, because you're going to be bearing the whole burden of the interest cost. You won't have any subsidy coming in into you to help offset the cost.
That's true.
But yet, we didn't extend the debt anything out of what we would typically do. I mean, it's still 20-year debt. It's still within the useful life of the project, things like that. We want to make sure we're still in line with our bond councils and everyone.
Okay.
All right, on the next slide, which is on page 5, this is net debt per capita. And this one is actually benchmarks yourself against Standard & Poor's, which you also have a Standard & Poor's AAA rating. Moody's does not provide a benchmark or a median for this in terms of their clients and their AAAs and their AAs and single A's. Moody's periodically updates their medians. They do it every year about April, sometimes it's in March. S&P does not go in and annually update their benchmarking, their S&P very low or moderate levels, so we've kept them as is. There's been no change to their where they benchmark their local governments. So you'll see this includes your policy level and your net debt per capita. We've assumed that your population grows at 2% annually, just to be very conservative. I know that in years past, y'all have seen much more aggressive growth rates, so we've taken a very conservative route at 2%. And at no point do you get close to your policy level was set at it was a low place, somewhere between the very low and moderate level, so that S&P won't show any concerns with this particular ratio, since it is one of their criteria.
Well, now, that is just the debt. It's not how much we're paying back or anything like that, right? Isn't it the total debt?
It's the total debt.
So why is that so much lower than it was projected back last year?
It's your net debt per capita, so it's the net debt that your general fund will support. So it takes into consideration the two bond issues that you issued, $44 million and the $15 million. As we talked about, that there's a portion of it that's supported by the general fund, the rest of it is supported by other revenues that are coming in. So
this maybe is where that came into play then.
That's absolutely right.
From the previous, then that was including
everything.
Of it and not assigned to the other revenue sources, can we say? Or
right.
How would you say that? So, okay. Because I thought the debt is the debt.
The debt is the debt, you're right.
Yeah, so how could that be?
That's right.
Lower?
All right. And slide 6 is a ratio that works off of the previous one. It's the per capita debt, per capita income. It also works obviously off a population and growth assumption. We have a 2% growth assumption. Your per capita income, which over time you've seen substantial growth in that as well, the wealth of your individual, your residents, we actually have assumed at a 2% growth rate here as well. So you'll see obviously what's going to happen is that the graph moves in tandem, because it assumes over time your population grows at 2% as well as your per capita income. This is not a benchmark that Moody's produces their medians on, nor does S&P. However, we do know that as they go through these calculations, it's one of the ones that they look at. They may not produce it in a report. It was included in our debt policy level, and we set a policy at 3%. As you see, we've taken on the additional debt. Over time, as you pay off the debt and you see the increase from per capita income and your population, the ratio continues to improve.
And again, this is still based on the fact that we're That this is based on the assumption that we do not add to our debt.
That's absolutely, all of these ratios are based on that we're taking on no additional debt, but what we've accounted for to date, which is the 44 and the 15.7. And slide 7, I'm sorry, that's the slide that there was the Moody's median was not updated, and I did want to make sure that in your packet of information, you do have the update, because you'll see that the AAA median moved, and similar like we saw on the general fund balance as a percent of revenues, it's also moved in terms of and where you benchmark yourself, it makes the Franklin ratio look better or more in line, at least with a AAA level. This one is the net direct debt as a percent of market value. Market value, same thing. We've also assumed a very conservative, just for benchmarking purposes, a 2% growth rate. And the Moody's AAA median was sitting around a 0.5%, and with the new medians that were released for 2009, we saw that come up to a 0.64%. So that's why I wanted to make sure that you have the updated version. You'll see the blue line, which is the AAAs, has moved up a little bit and puts us a little bit more in line between our policy and where the AAA level is.
It's moved up 50%, hasn't it? Close.
The AAA level,
Yeah.
the AAA was at 0.5%, and now it's at 0.64%, the blue line. And we saw a slight move in terms of where the AA and single A's were, but in fact theirs was not as significant as you saw for the AAA level, so we wanted to make sure that we have the 2009 medians on there. Any question on this one?
What is market value? Market value of what?
Property.
In other words,
Tax base.
the
Tax base.
Okay.
And that is also one of those things that they go in and look at when they assess your credit rating. And you'll also hear it referred to, they'll refer to overall net debt, and that number in terms of percentage will be higher. That's when it takes into consideration all the county's debt. They do that calculation as well. They do it for every city, county. It's overlapping. It doesn't matter where you're at, they're going to account for the fact that you're within the county.
So
The
they
county
say-
has debt, the
So you
debt.
get a proportion of it.
So overall debt refers to that whole,
But in terms of when we were going through this process and providing a benchmark for you all, it's hard to look at debt that you have no control over and kind of go, what, where did my level go? But we do have, we know what we're funding and we know the debt that we're taking on, so it's nice to step back and look at this one in terms of benchmarking yourself versus the overall, because we could see 6 months from now, the county could issue $100 million or $2. We don't have any control over that. So, but you will see that in terms of in their reporting, they do reference it. I just wanted to make sure that you were all aware when they reference overall, it's the overlapping debt of any of the other municipalities or the
It
county.
includes all school debt, too.
That's primarily where you see the.
And Franklin-
that's-
and Franklin
Franklin
Special.
Special School District.
and,
So that's where you see, and
amazing.
Whereas there's, Franklin Special School District, is that in there?
Yes.
Should be.
so it's the idea of your residents, what's the what's the burden in terms of the overall debt in terms of where they live. I mean, that's why they look at that in that perspective. And then on slide 8, this is not very exciting because last time I showed it to you, it had all kinds of colors and all over the place, but I probably should have put some verbiage on here, but I figured I would have talked enough at that point. But I think that we ended up in a comfortable place, at least from my perspective, in terms of moving forward with the projects that the committee felt was critical in terms of cost, in terms of project cost and interest cost. We do see, obviously, we all kind of talked and we spent some time on that debt service as a percent of expenditures. We always knew it was going to be kind of a ratio that was going to kind of maybe give us a few kind of uncomfortable areas in terms of years where it's going to get out of whack. But overall, I think that considering where we expected to be, we are there. In fact, maybe in a little bit better position. We got some of these projects behind us under our belt. And with that, I also included, in case y'all have not heard enough about Moody's and their medians, their report behind this. It's in color, so exciting stuff, right? And just it's on this presentation, but we benchmark the city against the cities that they rate the population of 50,000 to 100,000. Obviously, y'all are on a little bit of the lower end of that, but we felt like it's a good place for us to be and to benchmark ourselves against. So, any other questions?
Actually, just something very small. I've just realized since I've got 3 of these out here, it would be good to have a date on the things that you send us.
You know what? I thought about that in the car. And look, mine says July 2010.
Oh, okay.
No, she means in terms of the presentation.
That's right.
Don't worry, because I had the same thing. I had the one that I originally sent you, and then I had the one from 7 months ago,
That's
whenever
right.
it was.
That's right.
And I read on here, so don't worry. Going forward, the date will be on there, I promise.
Thank you. I just, as I say, I was just looking at 3 of them, and I thought, I need to have this date.
And they all look exactly the same. You see, I'm very creative when it comes to PowerPoint.
Some of us have more of the benefit of looking at emails that have the dates.
That's right.
Let's go back and make sure we know
That's
the most
right.
recent.
So one of them has, it was item number 3 for this committee.
That's right.
I hadn't thought about that, so that's a little bit better.
It's a little bit. But yes, ma'am, I'll do that in the future.
This has been very informative.
Good. Glad.
You a war eagle?
What's that?
Are you a war eagle?
No, that's
No, obviously not.
No.
What? He's a numbers geek. What does he know about?
If he doesn't answer like that, my son's a number 3.
I knew what you were talking about, but I was thinking less.
Yeah, we have,
That's one of the tests we ask
Yeah,
all
that's
these
right.
money managers.
there's some questions on you like that, you'll be
That was
ready.
a new financial model.
War Eagle.
But it's for one.
I did ask him as we walked into the building, I said, does this building feel like something? And he said, there's people walking, it feels like a mall. And I said, were they going to ask me that?
It was a mall.
I know, I love it.
Hopefully it will not be much of anything after a while,
Any other questions?
down the ground.
Okay, well, this gives us a good look
your
at the
inoculation shot and
overall
walk
view
in.
of everything.
And I think if I could summarize, the idea was to give you an update, including all the debt that's been issued and the projects that have been undertaken before you go into the next CIP round.
Yeah.
And as you're looking at things and where we are, we begin reporting to you on, some of these projects that we're now beginning to finish up and close out, to get you comfortable with where the numbers are on all of that.
One of the things Russ included and put together, I think is very helpful, page 3 of this memo, that summarizes the changes that we've seen. If you look at that model that was adopted in the funding plan that was adopted and the model behind it in September of last year, I believe, is when we took final action, and where we are today, you've got a section for project savings, you've got a section for project additions, and then you've got the impact of what we got in terms of interest rates, how much lower those are compared to what we assumed, and just sort of aggregates all that to say we have about we're about 9.8 million better off if you look at it in terms of project costs and interest costs in that model than what you originally approved. So that gives you at least that snapshot compared to where we are now versus what you adopted.
And this reflects that.
And this shows all that, rolling through those ratios and everything, but it gives you one page to look at the true benefit or true position that we're in now compared to where we thought we'd be.
Any other, anybody?
Great comments.
Thank you very much.
Good job.
Thank you.
Safe
See y'all
travel.
next time.
See ya, thank you.
Item number 4 is the report on the fuel hedging.
Yes, I wanted to just give you a brief report on what we have done with the city of Nashville as far as going forward with the fuel hedge 1 year out. If you recall, you gave us permission to go ahead and continue that interlocal agreement with Metro for an additional year. The legislature gave us permission to go ahead now and do rolling 2-year hedges, financial hedges on fuel. We still have fiscal 11 hedged at the same price as we did last year. But what we were looking to do is go ahead and book from July of 11 through June of 12. We have entered a bid for both diesel and gasoline contracts. The gasoline contract, I'm told, is closed. I don't have the information yet, but I'll get that out to you. But what we do is we get advice from some experts who are looking at the futures prices, and they give us recommendations, and we typically will enter bids for something less than what their recommendation is. And then we wait and see what the market does, because we've got the luxury of that 1 year to encounter that. So that's where we are right now, and as soon as all those contracts are completed, we'll produce a report and get that to you. I will tell you that about 2 hours ago, we got the report for June, and for the full year, we ended up making $43,100 on our fuel hedge, which is about 5% of our total fuel usage, and that breaks down. Really, the biggest reason we wanted to enter into that was because of our use of diesel in solid waste pickup trucks and fire trucks and some of the larger vehicles. But combined, we saved about $19,000 on diesel and about $24,000 on gasoline. So it never works exactly the way you want it to, but it did work in our favor this year. And we hope that, and expect that it will do so again next year, just because it's unlikely at this point the prices are going to go down.
The other thing it gives us is a greater degree of certainty when we budget.
When
we
we
have
budget.
60% of that price, we pretty much know what it's going to be. So it gives us a better foundation to build budgets on, so.
Good.
There are always fluctuations, because right now, the price of oil is down, but...
A little bit, that's right.
That's right.
How much?
But it does give us certainty.
Gasoline.
Okay, so really, no...
No action.
Just informational.
That's just a
Yeah.
report.
Okay.
And you do have, I think, in the packet, the reports of fuel usage by department, in case that's interest you.
Yeah.
And you did have the summaries, the financial summaries, through the end of May. And we'll get the June out to you.
Very good. Okay, number 5 is the resolution 2010-58, resolution declaring the intent of the City of Franklin to reimburse itself for certain expenditures relating to public works projects with the proceeds of bonds or other debt obligations to be issued by the City of Franklin in an approximate amount of $30 million.
This is always my least favorite resolution because it's so darn hard to explain. But this is something that the IRS requires that we pass in order, if we ever want to reimburse ourselves with bond proceeds in the future. So we have already passed reimbursement resolutions for Columbia, for Carruthers, for McEwen, for a lot of things. We've not really done it for 3rd Avenue and Hillsborough. So this is a not-to-exceed number, and it just allows us to go ahead, proceed with the project, incur any costs that are related, with the proviso that we can turn around and issue bonds for that uncovered portion of the Hillsborough project at some future time, and be able to carry that money back and reimburse ourselves for any money that we've spent. Does not allocate any money for any reason. It just gets us on the record in terms of saying that we will reimburse ourselves.
Money that we would have already spent.
Money that we would have already spent by then, that's right.
Well, now, we probably do need a recommendation
Yes, please.
to
Move
send
move
this.
to recommend to the full board.
Second.
Any discussion? All in favor, say aye.
Aye.
Opposed, no. All right, item 6 is the conference, the 2011 conference center budget.
Again, this is more informational than anything else. In prior years, we typically, at the May meeting, have the folks from the conference center come and explain their budget and give you kind of an outlook of where we are. But with our flood and budgets and everything else that were going on, they did not do that. The numbers from this budget are incorporated in our hotel motel tax fund, but this is purely for reference only. This gives you their FY10 and FY11 budget and the variance between the two for informational purposes only.
How many times have we had to pay out for that, out to this year?
Well, in this year, I would say
For the
there are probably, I know
2009,
Mike's in the
2010.
audience, it's 3 or 4 months that we've had to actually write a check to them this year.
That's unusual, too.
Well, actually, that's pretty normal. What has happened in the last 5 years, they've done so well that we just have, I mean, we've rarely had a month in a fiscal year where we actually had money going their way. Typically, it's money coming our way. Now, for the end of the year, I think we're going to end at a break even or a little bit above when we get when we have the final June numbers in. But typically, 8 months of the year, they make money. 4 months of the year, they don't make money. It's pretty close most of the time. And we do, and whatever they make or lose, the city pays half and the county pays half. And that's been the pattern since 1998. I guess the one thing I would point out is all of the convention centers that I read about are busy losing money. And we've had one that consistently, at least the entire time I've been here, has made money and contributed every year. That's very much part of the reason that the hotel tax fund has a fund balance that's there for our use. And that's because from the beginning, there was money assumed that it would cost to have the conference center, and instead they've produced money. So the hotel tax that has come in has been able to go entirely to pay debt service and to accrue as fund balance.
Well-
And some other things.
And pay some other things.
But now, I was looking on the last page of item 7. Does that mean that for May, we're paying, I don't know what the parentheses means.
That means it's a deficit.
So
So we will send them $24,000 for that month. And again, the agreement that we have with them is that we settle up every month. That way, if, they may owe us a lot of money, we don't want them to sit on it and wait until something offsets. The agreement is we settle up every month. We either get a check or we write a check.
See, Russ, so what you're saying then, this year is not totally unusual? I mean, outside the other few years, I mean, it's
If you
a
go back
bit, but it's not,
If you go back to '98, it's more the norm. It's closer to the norm than what we've seen over the last 5 years.
okay. And you're
Okay.
saying about 4 months?
In terms of the number of months, in other words, there are certain months that they do very well. They have weddings, they have all the
Right.
Christmas parties, they have those type of things. But February is usually not a knock-'em-dead month for conference centers. Conferences usually happen from the end of March until the middle of May. They do very well then, the bookings are high. But in some of the months, they just really don't have anything.
What months are you saying that they usually do well? I'm sorry, I didn't hear you.
The months,
Months? Yeah.
well, I know the government conferences that many of us attend usually fall in April and October.
Okay,
So those are pretty strong months. I think the summer months, they do weddings. I think around Christmas time, they have a lot of corporate Christmas parties and things like that. They have regular business, but it's a fairly large place, so to really fill it up and get it past the break-even point, they have to do, family things and community things as well as, conferences of people coming in.
Now-
This has nothing to do with their room.
No, oh, I know,
allocations.
this is the conference
rental
center.
of the conference center and the food and drink operations.
And we have till, when is it, 2013 to pay this, or is it 12?
I think the debt matures in 2013, which will actually be, I think it's in the fall of 13. So it'll be in fiscal 14.
So we should be
make
done with
the
that
last
debt.
payment.
And then debt
All
service
right,
will be.
have we had any more news on interest from the Marriott or anyone else on that? It just sort of, we're sitting tight with it right now, right?
Well, the understanding that I have from the bankers that I know is that, nothing to do with a conference center or a hotel is really bankable right now. I mean, banks have tightened credit substantially. It would be very difficult, I would think, to fund that unless you have private equity, that's looking to probably take over the hotel and do the conference
And
center.
once we have all this paid off, it'll be good, so.
So let me just ask you then, on item 7, and I guess I was looking at this with this, but I guess we can wait until we talk about item 7. Are they showing a deficit for the entire year?
Yes.
Okay.
Year-to-date,
I can't, it's hard to read these.
Yeah, it's on that, it's on that last.
Is it on
Last page
No,
on
this
7.
is the, I'm sorry.
The-
Maybe we better go to
Number
that
7.
then instead of,
The one thing that I
Number
would
7.
point out here is that, for the year-to-date, they have, let me see if I've got the right
Check that
numbers
last
here.
page.
Here's where we are.
Okay.
There's the actual.
so
What are you talking about, Russ?
so wait,
Where are
so
you?
this just shows how far below the budget it is.
What, no,
does- okay.
this is going to be negative, but if I may, if you look up there, they have
Where
gross
you-
profit less the fixed expenses. They actually have a net of $45,000. But we require them, as part of our agreement, to set aside 4% of their revenues in escrow for capital expenditures. And if you've been there within the last year, you've seen they've redone the walls and the chairs and almost everything
Video.
that they have. That's money that's been accruing since 1998, that's been building up, that they spent for that. But we require that they do this so that we always know that there's that. So before the set-aside for fixtures and equipment, capital expense, they were profitable. But once you take that out, they are negative for the year.
Let's go back to item 6 then. This is just their projection. Or this is their actual?
These
For
were
the budget,
projections.
this is budget numbers.
These are budget.
Well, even on the 2010,
This is for
it's-
the
you
whole
can see
year?
it's actual or estimate. At this
Okay.
point, when this budget was done,
This is for May. This is for May?
this came to us the end of
Yeah.
May, they were still
This is year,
projections.
these three are for the year, so this is going to be the deficit.
Okay.
So they're anticipating,
But half of
A
that
profit
is
next
little
year.
account.
Right.
after a deficit this year,
I see down here on the bottom, they have that in there too, as a deficit also.
Right.
I didn't catch that. I had it, it was hard to read this
Yeah,
one
I
right
can see
here
it
for
in
me, and so I didn't really look on it as much as I,
but prior to the 4% set aside, they actually have 150,000 profit.
that explains
Where's it
some
show
things
that?
on this. And as I say, this was a little bit hard to read, and so I wound up not.
We do get fairly elaborate reports from
Right,
them from time to
that's
time
right.
with breakdowns. And I must say, I have not looked at every one of them, every line on every page, but their revenues have looked very similar to our revenues. And they've done an outstanding job of cutting their cost in order to keep them in line and get to the point where they're only as far down as they show.
So this is just something that we,
Is there
Just
action
make
needed
note
for
of.
this or not?
There's really no action. You've adopted the net figure as part of our budget already.
It's all factored into the hotel motel tax.
That's right.
Dollars.
and we had gotten into number 7 on the informational reports, and this last page, the last page of item 7 is where we're looking
You have
at.
that May report.
The month to month.
Right, the month of May report, and the year-to-date, though showing deficit on that also.
Right. And you've seen the sales tax report for April. That was just a summary of that. We expect the sales tax for May probably early, Monday or Tuesday of next week. So that will tell us a lot. That will be,
Right.
if it's positive, that'll be the 4th consecutive month where we've had a number above the line.
Right, right.
Yes.
which looks good to us.
They do look
Looks
nice.
very good to
I
us.
had forgotten,
We should know May.
It will be an interesting month.
May be down.
May might be a horrible month because of the floods.
We lost that,
I mean-
obviously, a weekend of retail sales at the mall,
Sales and
that first weekend.
other things. Now, on the other hand, maybe Home Depot and
That's
Lowe's
right.
and.
What happened later in the month might have upset.
We don't know how that.
We didn't waive
Could
sales
balance it
tax for the
out.
month of the
No, we did not.
No,
have to
thank
do
heaven.
this.
Yeah,
But,
so-
you know-
So that could balance itself
Yeah,
out
and, you know,
over the
it's
2 month
gonna be a-
period.
a-
Saturday,
odd
Sunday
month.
before Mother's Day, and, you know.
Want to take bets?
It may have an impact that we don't know.
We don't know.
I use the excuse not to buy my wife for Mother's Day.
Yeah, good. Good deal.
Linda, did you get that? Did you get that
Plus,
one? The flood, you mean the flood that was 2 weeks ago?
that's right, the flood.
Good luck with that one.
Yeah.
And so, for year-to-date, now, this does not include May, we're just down 2%.
that's right, the
That's
7% and the 9% months
We've made
That's
a
right.
lot of
made up a lot of
catch-up.
ground, so,
a great deal.
you know, we do have the May report and the June report left to go before we will actually close the year.
So it's possible that we'll be very close to it. then.
We may be close
We
to
could
it.
get ourselves back up, yeah.
Well, I mean, 2% is close compared to where we were,
Oh, yeah.
what, 3 or 4 months ago?
Oh, absolutely.
Yeah, it is.
Well,
as you
get ready
say.
for dives.
Any other
It's gonna be
comments
trouble.
about these? Yeah. And item 8 would be discussion regarding the regular July meeting date. And, at least I wanted to get the PFM material before we had our next Waterman Alderman meeting, so I appreciate getting that together. But do you want to say something about?
Well, from a staff perspective, we don't have a lot more material to bring to you later in the month in July. What we have online going for August would be an update of the water budget. That will be ready to go by then. There's additional work that they're doing on the rate study side that won't be ready till then. Otherwise, we might be able to bring that later this month, but we'll be fully prepared for August. And as you remember on that, you adopted sort of a 2-year budget with a update coming in that second year, and that's what we'll be looking at. And do want to also update the rate survey, rate study information as well. So that's really the big piece that we have that won't be ready until the August meeting. So it's really up to you what you'd like to do, and if there's other information you want to cover in July, we're glad to do it. But from our perspective, staff perspective, we don't have a whole lot of other items to put on here that are urgent to take action in July. So you could kind of split the difference and make this a June-July meeting and move on to August and make up for all your extra hours that you were here in February and March and April.
Thank you, and I originally had
Look at
thought
that,
that this
don't
would be, the special meeting would just have the PFM. But since you've got all the rest of it on here, I think that makes it extremely convenient.
That was an incentive for us to hurry up and get these other couple items on.
Well, I guess that was a motion and a second, though, so
We're doing it.
our motion will be that we will not have our next meeting until August.
And I think that's August 19th. I don't have my calendar in front of me, but I think that's right. What time do we want to do? We've had a moving time on this from 4 o'clock to 5 o'clock
Well,
to,
let me tell you, that
Where
will
are
be the
we?
last one that I can have early.
Okay.
Because, once it gets to
so
that
this
next
could be a
meeting,
4 o'clock
it
in
could
August?
be,
Okay,
yeah, because after that, though.
okay.
So the third Thursday is the 19th.
That's the 19th of August, and we'll go with 4 o'clock if that's okay.
Would you get the violins out for Ms. Alderman Peterson?
Just because some of you are. Anyway, can we have a vote on them having our next meeting on August 19th, and we will say 4 o'clock? Okay. All in favor, say aye.
Aye.
Opposed, no. Okay, good. Oh, well, wait. Okay, well, let's look then.
I will not be here. I don't think.
Okay, so you're saying
We'll
aye.
have 3 of
Okay.
us.
So it'll be 3?
Okay. it'll be 3. And
But I can be convinced to change.
well, we all have agreed then that we do not want to meet
I
again
may or
in
may not, but I
July.
don't think I'm going to be here.
That is the effort.
That was unanimous.
Well, we'll go then with
It
the,
is July.
and I mean, not have our regular meeting,
Yeah.
which was supposed to be an addition.
We've already had a meeting.
That's right, we've had a meeting, okay. So
Doubled up.
we're for August then.
Yeah.
Then I guess
We're done.
there's,
Very good.
This meeting is gone.
I didn't say anything.
He nodded a couple
Lucky you.
times.
Not at all, I know.
Nodded off one of the